We have a really outstanding panel. Their bios are in our packet. I will just briefly say who they are. Pam Olson is, forget her title, Deputy Director of National Tax at Price Waterhouse, and she used to be Assistant Secretary for Tax Policy at the Treasury Department, among many other things. Roseanne Altschuler is professor at Rutgers University and used to be director of the Tax Policy Center, a very important position, and also was a chief economist on President Bush's 2005 tax reform panel. And finally, we have Adam Looney, who is a senior fellow at the Brookings Institution and recently was Deputy Assistant Secretary for Tax Analysis at Treasury, among many other things. So I'm going to start with Pam, who's going to explain why we needed this reform, and Roseanne and Adam will try to explain what it did, and then we'll open it up to the panel discussion.
Okay. Thank you. Good morning, everyone. So I think Chairman Hatch laid out a little bit of the rationale for tax reform, but I'll go into it in a little bit more detail. First we had the highest statutory rate here in the U.S. relative to the rest of the developed world. The U.S. statutory rate came in about 15 percentage points above the OECD average. We had a worldwide system with imposition of the tax deferred until profits were repatriated from offshore. That disadvantaged investment in the United States. As a now retired tax director used to refer to it, the system was the 35% investment tax credit to keep my profits offshore. The result was that we had about $2.5 trillion, or a little bit more by a Joint Committee on Taxation estimate, of foreign profits that were indefinitely reinvested outside the U.S. And then we had the impact of those two together on business decisions, and it really created an uncompetitive playing field for the United States when it came to decisions about where to locate the ownership of IP, where to locate operations, where to make investments, and where to headquarter a business. And so those are the reasons that I think we really needed, from a business perspective, to do business tax reform. Then I would say, putting on my former Assistant Secretary of the Treasury hat, there were also some policy flaws with the system that, in addition to the business, what one would see as business flaws. And those were that the system provided limited protection of the U.S. tax base, an unlevel playing field for U.S. versus foreign businesses. And when you combined the highest rate in the developed world with the worldwide system, it resulted in global distortions as companies tried to avoid the impact that affected other countries' tax systems as well. And finally, I would say that we had really the lack of a stake in the ground on our jurisdiction to tax income. Another point to keep in mind is that this all occurred in the context of the OECD BEPS project, which was completed a couple of years ago, and which other governments were in the process of implementing. The BEPS project had 4 minimum standards on exchange of information, anti-treaty shopping, country-by-country reporting, and dispute resolution. Those 4 minimum standards were things that the United States could implement administratively without a need to change the law. But then there were a number of recommended practices that came out of the BEPS project. Those included anti-hybrid rules, stronger controlled foreign corporation rules, minimum tax, limitations on interest deductibility, aligning transfer pricing with value creation, and preventing the artificial avoidance of permanent establishments. Those all required legislative changes in order for the United States to be able to implement any of those recommended practices to the extent that the United States chose to do so. So what came out of the Tax Cuts and Jobs Act? Well, a significant reduction in the corporate rate, obviously, from 35 to 21%. That brought the average our average statutory corporate rate, when you take into account state and local taxes, to the middle of the pack, to about 26%. That's approximately 2 points above the OECD average, so it was, I would say, a fairly responsible reduction in the corporate rate. There's been a lot of talk about a race to the bottom when it comes to corporate rates. We clearly did not win that race, but we entered the pack. That's about a 1 percentage point below the OECD weighted average. It converted us from a worldwide system to at least nominally a 100% dividend exemption. I have colleagues who complain mightily that we shouldn't call this a territorial system because there are so many provisions that apply now to international income that it's, they, in their view, not fair to call it a territorial system. But so we adopted a 100% dividend exemption system. That ended the disincentive to reinvest foreign earnings in the U.S. We also retained most of the CFC rules that were part of prior law, and in some cases we strengthened them. And then we imposed a one-time tax on unrepatriated foreign earnings as part of a transition to the new system, which removed, and I think this is important particularly from the standpoint of confidence in the system as well as international foreign governments' interest in taxing U.S.-based multinationals, it removed a financial statement target from those companies. With respect to the policy perspectives, the implementation of BEPS, there were several base protection measures that were part of the Tax Cuts and Jobs Act. And in keeping with the season, I would say that 2017 was Fat Tuesday when it comes to tax planning. The Tax Cuts and Jobs Act significantly changes the landscape. So what did we get out of the Tax Cuts and Jobs Act on that side? Anti-hybrid rules, limitations on interest deductibility, 30% of EBITDA transitioning to EBIT in a few years, with no relief based on a more favorable worldwide leverage ratio. So we ended up with rules that are tighter than the rest of the world when it comes to interest deduction limitations. Rules tightened on the transfer of intangible assets offshores. Again, some strengthening of our controlled foreign corporation rules, and not one but two minimum taxes. And that's where you'll need your placeholder there with the acronyms. One, the Global Intangible Low-Taxed Income, or GILTI for short, and then the Base Erosion and Anti-Abuse Tax, or BEAT for short. The GILTI and BEAT are both formulaic changes to how we tax foreign income, and together they'll significantly reduce both opportunities for and the incentives of foreign tax base erosion by U.S.-based companies, and importantly protect the U.S. tax base from erosion. Just a couple more words before I'm going to hand it over to Roseanne to give us some more details. But I think it's important to think about the policy rationale for the two minimum taxes. If I were queen and could have written the rules, I might have gone in the direction of saying we need to fix our transfer pricing rules. We need to look harder at how we allocate the right to tax and do a better job of staking out what should be within U.S. taxing jurisdiction versus what should be in other countries' taxing jurisdictions. If we go back to the House blueprint that was released almost 2 years ago now, June of 2016, that included a complete redo of jurisdiction to tax because it focused purely on whether the goods or services were ultimately consumed in the United States, and if they were, then all the profits related to it would have been taxed here in the United States. That idea never picked up steam. It became known as the BAT tax, and the responders' take on it, would you rather have a job or cheap underwear, never caught hold. And so we didn't end up with that redrawing of jurisdiction to tax, and instead we end up with a system that's kind of halfway there. But so as the legislature was working, as Congress and the staff were working on these what became the Tax Cuts and Jobs Act, it was clear from both sides of the Congress that there were going to be significant changes on the international side, that neither side was comfortable with reliance on transfer pricing rules or our ability to write better transfer pricing rules. And so instead, we went in the direction of minimum taxes. Now, minimum taxes are in some ways simpler, but there was a lot of concern that a very strong minimum tax would put U.S. companies at a disadvantage relative to foreign companies that wouldn't be subject to the minimum tax. And so what evolved was a less strong minimum tax that's a global minimum tax that hits U.S. headquartered companies. And then in addition to that, a second minimum tax, the base erosion and anti-abuse tax, or BEAT, that applies more broadly. So what the BEAT fairly it's going to have a lot of unintended consequences. All these provisions are going to have a lot of unintended consequences. But what it really does is to put both U.S. companies and inbound companies that are serving the U.S. market from outside the U.S. on the same playing field and subjects their profits to a level of tax. And so I think it was a really important step in the process when both House and Senate came out with provisions that did kind of the same thing. And so with that, I'll hand it back or over to Roseanne.
Okay. I guess I'll get into the weeds a little bit. This stuff is kind of difficult, so I think I'm going to be a little bit repetitive. I can't stop myself from starting by saying something about the rate cut. It's a big deal, 35 to 21%. Pam has given you some context for that. Not surprisingly, the standard deviation across countries on statutory rates has decreased, and that's important for income shifting and location incentives. That's also going to be the case for average tax rates. So that's something to keep in mind. Dividend exemption system, which was sometimes called a territorial system. So we've moved to a dividend exemption system with anti-base erosion measures, which keep our system a hybrid between territorial and worldwide. So we had a hybrid before, we have a hybrid again, but now more specifically we have dividend exemption or territorial for low margin foreign source income, low margin investments abroad, and a worldwide system without deferral, current taxation for high margin foreign source income with an 80% foreign tax credit limit with no carrybacks and no carry forwards and expense allocation. So I'll get back into that in a second. The deemed repatriation, as Pam said, as part of a transition to territorial, you have to think about what do you do with all of those earnings that are sitting abroad. So we have a one-time toll tax on undistributed, non-previously taxed foreign earnings. This is the big revenue raiser on the international side. This is what makes it positive. So it's a 15.5% tax on cash and liquid assets and an 8% tax on non-cash assets. It can be paid in installments over 8 years, and foreign tax credits for the portion of earnings that are subject to the toll charge are going to be allowed. So again, this is why the international package together raises revenue. And then there's what Alan Auerbach at a recent conference at Georgetown called presumed guilty minimum tax, which I thought is great. So guilty is I don't think Pam spelled it out. It's the global intangible low tax income provision. What's important is that it's not necessarily intangible income. We kind of back intangible income out. It's not necessarily low tax, but let's start by outside of the weeds, and now I'll explain that. So it's a minimum tax on foreign source income that's operated through a deduction. What I first have to do is define what guilty income is. It's foreign income earned over 10% of tangible assets. So it's a measure of excess returns over a 10%, which is pretty generous return on your assets abroad. Marty Sullivan has written a lot of great stuff on this. He called that 10% pulled out of thin air. Now, I wasn't here when it happened, so I'm not sure where that came from. But once you've calculated that GILTI income, you get to deduct 50% of it, okay? And it's going to be a 37.5% deduction after 2025. So that becomes a 10.5% minimum tax, but you only get credit for 80% of foreign taxes. And the idea here is to retain the incentive to minimize foreign taxes that you pay abroad. So that brings the threshold for the minimum tax to 13.125%. That's the number that you need to remember. But it assumes, just as an aside, that the foreign countries are going to use the same base that we use. So that threshold isn't really a threshold. The idea here is to provide capital import neutrality for firms that are earning low or normal returns abroad. These are the firms that you would think are facing the most competition when they set up shop abroad, and then capital export neutrality for excess mobile returns. So that's the policy rationale. One of the things that is not so obvious when you first look at this is that Congress kept the expense allocations rules that force multinationals to take some of the expenses on that they in the United States that are supporting their foreign operations and allocate those to foreign source income. And so that would be a G&A, general administrative expenses, right? R&D, interest. And so those expense allocation rules still hold under the new law, and they go towards the GILTI basket of income. And it turns out, the reason why you should be glad that you listened to me say all this is because what happens is you can end up owing tax on GILTI income even if you're in a country that has a higher, even if your average foreign taxes is greater than 13.125%. In fact, you can even pay GILTI if your taxes are greater than 21%. So that's why it's not necessarily intangible income because it's backed out, and it's not necessarily low tax income. And it's an overall structure. So you don't go country by country when you're looking at whether or not you're above or below the 13.125%. You look over your entire operations, which means that if you are above that 13.125%, you still have an incentive. When you invest in a low-tax country, you still get all the benefits of investing in that low-tax country, and all of the incentives that existed before to income shift still exist in the low-tax country. So it's complicated. Then there's FITTY. So that's the foreign-derived intangible income. So Congress took a carrot and a stick approach to trying to attract intangible profits into the United States. The carrot is this incentive under FITTY for domestic intangible investment, and the stick is a penalty on foreign intangible income. And so what really, if you wanted just a shorthand for FITTY, it's a patent box, but it's not just on patents. It looks at the foreign share of returns above 10% on your tangible assets. So it's kind of a perverse incentive, if I have it right, you have the incentive to put tangible assets that are earning less than 10% abroad under GILTI, and you also have that incentive under FITTY. It operates as a deduction, and so it gives you a 13.125% rate on foreign-derived intangible income. So that's instead of the 21% rate. The score would suggest that Congress doesn't think it's going to be used too extensively. It's not on foreign sales per se. It's on how much you earn on your foreign sales. I think one thing that I'll say about it, there's still an incentive to put intangibles abroad. It depends on whether or not you're above or below that 13.125%. And it's certainly a windfall for those that are paying royalties back to the United States. Problem is that it does not seem to be legal under WTO. It's inviting a WTO challenge for sure. And it looks, if anybody's familiar with FISC, DISC, FISC, ETI, it looks like an export subsidy, and it looks like it's not going to survive. So I think there's a lot of uncertainty here. And then I guess I'll just say a little bit about the BEAT before. This is the global add-on minimum tax. It's aimed at foreign multinationals with operations in the United States. But as Pam said very, very well, it applies to U.S. and foreign multinationals. You have to make a certain, you have to be over a certain 500 million of gross receipts over a 3-year period. You have to have a de minimis amount of related party payments. But if you do, you're going to pay an alternative minimum tax on your related party payments. So I think that's the easiest way to explain it. Those related party payments do not include costs of goods sold. So that does, of course, give you an incentive to bury fees for services and royalties paid to related parties into your cost of goods sold. The bulk of the burden is going to be on inbound investment, but it also does, of course, affect outbound investment. So there's a problem here also in that it may violate our treaties. So it's not clear how long that's going to be around. Then there's the anti-hybrid, just small problems. Anti-hybrid rules that Pam talked about. And then it's just to highlight again, we're going to be talking about what this does for incentives to invest abroad versus home. At home, remember, you're going to have expensing for 5 years. There's going to be this interest limitation that Pam talked about, 30% of EBITDA going down to EBIT in 2022. And NOLs, net operating losses, we've changed how those, how you can use those under current law. That you can only offset 80% of taxable income, and there's no more carrybacks. So a lot has changed. And I guess what we're going to get into soon is how that affects income and investment in income shifting incentives. Okay, turn it over to you.
Well, thank you. So I feel like we've covered a tremendous amount of ground already. So I'll just say a few things. So the first thing I want to say was probably the most consequential choice in this reform was the choice to retain the existing corporate system in broad brush. So what I mean is that we're going to continue to tax corporations based on the residence and the source of their profits. That means that differences in tax rates across jurisdictions and differences in the regime that is applied to corporations is going to continue to matter for where companies decide to locate, for where they decide to locate their operations, and for their incentives about whether to try to avoid taxes and how to do that. And so in that world, that means that we're going to have to retain essentially all of the tax compliance and administration apparatus that we had under the old regime. So we still have all of our Subpart F regime. We have all of our foreign tax credit regime. And indeed, we've added new minimum taxes onto that. So the tax system is at least as complicated as it was before, even if certain pressures are relieved. And so again, in that world where taxes continue to matter for locational choices, you're in a world that is in some ways second best, where we're going to continue to have to pursue these issues and police, in effect, the border. And where the policy choices about what the minimum tax should be or what the BEAT should be are ultimately efforts to minimize or balance competing imperatives and competing risks. The second thing to say is that in the international tax world, the reduction in the corporate rate is a really big deal because it takes a rate differential that used to be 35 versus something very low and reduces it to 35 on our side of the border and something very low on the other side of the border to something that's much closer to parity. And so I think that in this discussion of international, we're going to focus on that as a good thing. I think it's also helpful to remind ourselves that just like 6 weeks after signing into law a tax bill that is about a tax cut of about $250 billion a year before it starts to phase out, we enacted spending increases of $150 billion a year before they expire. And so our long-term fiscal situation is, it was bad to start with, and it's much worse now. And so we're going to need to have much more revenue, and we're going to have to get much more revenue from corporate income. either at the entity level, at the shareholder level, or when it is consumed. And so I think, I'm trying to differentiate the incentives about how the rate improves things on the international side. The dramatic rate cut in broader context is not an unmitigated good, and it leads to a lot of instability, I think, going forward. But going back to that comparison of the level before and after, so clearly there is a reduction in the difference in the tax rate that's paid on the U.S. side versus the foreign side. And yet there are still clearly issues that need to be resolved, and those are addressed in part by the minimum tax that was discussed previously, and the base erosion and anti-avoidance tax. And so just very briefly on those things, the idea there is that if we're going to have a 21% rate on income on one side of the border for domestic U.S. corporations, we're going to have some provision that prevents them from easily shifting income or activities to a low-tax foreign jurisdiction to avoid the tax. And so whether the new minimum tax achieves that, I think, is a little bit unclear. It is the tax rate on the foreign side is very low. The base of that tax is very porous, and there seem to be a lot of opportunities to achieve a very low rate on foreign source income. And so I think that suggests that the incentives for profit shifting, for tax avoidance, and for locating certain types of activities abroad will persist. Similarly, on the inbound side, the problem prior to this reform and continuing to some extent after this reform is that a foreign-owned U.S. domestic company could achieve very low tax rates by making deductible payments from the U.S. to a low-tax foreign company. So, for instance, you could load up your domestic U.S. subsidiary with lots of debt, pay interest to your Cayman related party, and achieve a very low overall tax rate. So, as Roseanne said, there are several provisions that attempt to reduce the opportunities for that. 163J, the provision that limits interest expense, is one that partly addresses that. The base erosion and anti-avoidance tax also helps to reduce some of that. In that regard, the tax rate might still be relatively low, and I think it's unclear whether some of those provisions will be able to go into effect. And so what I mean on that, just to give you one example, it's clear that under the base erosion and anti-avoidance tax, some companies will pay the beat on on income that is generated in the United States, and then will be taxed a second time on that income when it accrues to the foreign parent. And I assure you, the company nor the country where that company resides will want to pay that double tax. And so that's an issue that I think will need to be resolved, and I'm sure it will be litigated. And so I'll pause there.
Okay, well, let me first ask, does anybody want to add anything to anything anyone else has said? And
I want to make one comment, and that's that one of the things that's really important to bear in mind here is that this is not a simple chess game with two parties. It's a multidimensional chess game, and other countries are doing a lot to change their tax systems and reacting. And so some of the things that have historically worked for tax planners have kind of been on the way out because other countries have been implementing BEPS. And so it's going to be important to bear in mind what other countries do as we think about what the incentives are going to be on a going forward basis, because some of the things that have been possible in the past are not likely to continue to be possible in the future.
Okay, so there were sort of two general complaints about the international system kind of going in. One was it encouraged U.S. companies to invest overseas because of deferral and a lower effective rate on overseas investment. And the other was that it put U.S. companies at a disadvantage because we do have this residual tax. So given that we've changed the way we do these things, are U.S. companies now at a smaller or bigger disadvantage than they were before? And is the incentive to invest in the United States smaller or bigger than it was before? and how much of those changes are due to the international rules and how much just simply to the lowering of the corporate rate? That's a lot of questions at once, but you can start, Roseanne, but I'm sure.
Okay, I'll just randomly answer. So,
Okay.
I think that we've pushed. So first of all, I think there's a lot of uncertainty and I think instability here in the law that undercuts incentive effects. So if you're not sure the provision's going to be around, you may not, repatriate your intangibles home or something like that. That's just as an aside. I think that overall, and I'll try to be quick, I do think that this pushes into the direction of making the U.S. more attractive, making firms low return investments, by low I mean under 10%, more competitive abroad. There's definitely an incentive to put your tangible assets abroad. There's more of an incentive to put your intangibles at home. So everything, I think, has gotten, a way to summarize is everything has gotten more compressed, but there are these kind of, I don't want to say perverse, but in terms of, it really matters on on your facts, tangible versus intangible, what kind of services versus non-services. It's going to be difficult for this to figure it all out, but I think U.S. more attractive, U.S. firms more competitive, income shifting less, things are compact.
Okay. Do you want to?
Sure. So I think that there are two broad ways of thinking about this competitiveness. And so I think on one dimension, and the dimension that motivated this reform, there's clearly an improvement. So I think that, as Pam said, that there was a perception that the U.S. was an unattractive place to locate a large multinational corporation. It was unattractive to do research and to make large investments, especially investments that you plan to exploit by making sales globally. And so I think that if you believe that having a very low effective rate on corporations encourages large corporations to locate in the U.S. And makes it attractive for them to grow here, then I think on that dimension it certainly has worked. It is a much lower tax country than it used to be, and much more attractive, especially for companies that have a lot of overseas income. I think on other margins, again, there's not a perfect solution to this problem. And so I think on other margins, there are clearly incentives, new incentives or enhanced incentives to locate certain activities abroad. So in certain cases, the tax rate domestically is still going to be 21%. In certain cases, it will be possible to achieve very low tax rates abroad, both because of the I don't know what the right term is, but the allowance for corporate equity, the 10% exclusion for income associated with tangible investment, and the ability to use excess foreign credits from a high tax place to cover income from a low tax place. There will still be very strong incentives for some entities to locate activities abroad, and I think that those types of activities can be important. So on net, I'm not sure that what the overall impact will be.
So I think the 21% rate covers a multitude of sins. I think that the willingness of businesses to restructure things or to make investments that they wouldn't make absent taxes has significantly gone down. And so I think that by itself does a lot to improve the competitiveness of the United States. There was an article a month or so ago that kind of had a bad headline on it about the effect of the Tax Cuts and Jobs Act on investment in the United States. And the first 2/3 of the article were sort of all these bad things, and then the last third of the article was about all of the good things that companies wouldn't be doing anymore because of the reduction in the corporate rate that kind of puts the U.S. in the ball game relative to other countries. So it makes it easier for you to source supplies and kind of a long list of things that you're just not. It's not worth the effort that you would have to go through in order to move some kinds of activities offshore with the significant reduction in the differential between the U.S. and other countries. And again, I'm going to go back to what other countries are doing. There's a lot of effort outside the United States to grab a greater share of the profits of U.S. multinationals. So, and they're looking at it on a global basis. And this is the U.S. Congress's response to some of that. And I think it's one of the things that affects companies as they look at where they want to put their investment, because the United States is going to be a strong place for that investment to be on a going forward basis, for profits to be generated on a going forward basis, relative to disputes that you might have with other countries over jurisdiction to tax. And I also think that this is likely to be the first step in a longer discussion that we're going to have on the global stage about jurisdiction to tax. You know, if we look at the start of the BEPS project, there were a lot of loopholes, discontinuities, inconsistencies between tax systems that the project set about closing, but it didn't set about closing them with a view on who got to tax the income. That's a discussion that we still have to have. And in many respects, the base erosion and anti-abuse tax takes a step in the direction of saying, let's look at destination bases as a way of deciding who has the jurisdiction to tax. And so I'm going to take a more positive view on what's going to happen ultimately with this in the international space about whether or not it's challenged by other governments before the WTO or the treaty violations are asserted. All of those things are definitely in the realm of what may happen. But I think if you look at the continuation of the BEPS project, there's a digital project that the OECD has picked up. And while it's supposedly focused on digital, the reality is that the entire economy is digitalizing. And so it's going to have spillover effects. There are the state aid cases. There are other governments that are enacting diverted profits taxes and multinational anti-avoidance laws, and taxes named for iconic American companies. There's a lot of unhappiness around the globe with the way that the tax system functions. And I think this is the next step in the discussion and may well take us further into the conversation that I think we really need to have about jurisdiction to tax.
So that's interesting. So you see this as the provisions that clearly were going to invite problems with WTO and GATT as helping us go to a path towards more destination-based taxation.
I think it puts it on the table for discussion, yeah.
So let me just ask one quick question. The 21% rate, which us catching up with the rest of the world, do you expect they will respond to that? And are we just joining a race to the bottom that will continue? And is this a first step in the erosion of the corporate tax worldwide, or is there some countervailing trends that you see?
I think it certainly is. And so I think that if I was another country and if I had spent the last 30 years trying to reduce my rate below the U.S. After the U.S. reduced its rate in the 80s, I think that seemed like that's what they did in the past. I think they have strong incentives to do it now. I think around the globe there are countries that are worried about how their patent boxes are going to work now that we have this min tax. And so I do think it provides that incentive. I don't think the min tax that we have really arrests that race to the bottom necessarily. And I also to say is that this is a race that those other countries are much better equipped to engage in. They have much more robust personal income taxes and shareholder taxes, where they have much more robust consumption taxes. And so they can weather a race to the bottom in ways that we can't, at least not with our current system.
Okay, I'm going to open this up to Joe. If you can just identify yourself and ask a quick question, not...
Okay, Joe Gutentag. Quick. The treaties, Roseanne mentioned she thought there was a violation. I don't think there's any violation of the treaties. Was there anything in the law which indicated that the U.S. intended to override any conflicts with the treaties? Adam seems to be the only person in the U.S. who's concerned about our revenue. And you did mention that was there any discussion of revenue sources? Like Pam mentions that we're competing with these other countries, all of whom or most of whom have a value-added tax, and I've never heard one mention of a value-added tax while this discussion was going on, and the reaction of other countries. I've heard that China has already proposed tax reductions on profits earned on income which U.S. companies, the cash which U.S. companies will leave in China instead of bringing it back to the U.S. and give them some tax benefits. Aren't other countries going to react viciously to our proposals?
A lot there, that and other countries' reactions.
So I think other countries have been reacting viciously for a while, and this is finally the U.S. getting into the game with it. Because, I mean, there's been so much going on around the globe, and we really haven't reacted to it because we haven't been able to legislate. You know, I'm like Adam, maybe like you, Joe, very concerned about the fact that we do, I think, need to raise more revenue in this country. Maybe we could say that there's been an unlitigated discussion that we need to have about the size of government and what we want to, raise taxes to cover. But clearly, when you watch the votes being taken, it would suggest that Republicans and Democrats are quite comfortable with the spending level that we've got, and therefore that means that we need to raise some more revenue. There is obviously one senator who has been brave enough to introduce a value-added tax bill, Ben Cardin from Maryland, and I testified before the Senate Finance Committee, I think last summer, and lauded his bill. I think at that committee hearing, there were a number of senators from both sides of the aisle who said that they were willing to at least talk about whether or not there ought to be another revenue source. I do think that we will fall short on the revenue side. I don't think we can get more money out of the corporate side, particularly if other countries respond by lowering their corporate rate. I think we've got to focus on taxing what we can tax, and that's income that's less mobile than corporate.
Yeah, I'm very much hoping that what this bill does is help us get to a VAT, because I think there are going to be problems with revenue, and I think that the question is, are we going to raise the corporate statutory rate, or are we finally going to start really considering a value-added tax, which we will never call a value-added tax. So it'll be like a GST or something like that, or business activities tax.
This lady's had her hand up for a while.
Yes, good morning. Thank you very much. I noted that, interestingly, Ms. Olson has actually been educated, at least academically, in the Midwest, which is unusual here at Brookings. My question is...
Get off the stage.
I'm sorry, but it actually... my question has a Midwestern slant to it, because Senator Hass mentioned companies that are offering one-time bonuses. But in fact, in Wisconsin, Kimberly-Clark announced that it was using the tax plan as a basis for corporate restructuring and was closing 2 plants in what was historically its hometown near Neenah, Wisconsin, resulting in a loss of 720 jobs in districts represented by Republicans. So my question is, to what extent will other corporations like Kimberly-Clark use the tax code as a basis for eliminating jobs and moving them overseas, or just corporate restructuring?
So my view is that the Tax Cuts and Jobs Act will indeed result in more jobs here in the U.S. than around the globe, because I think it shifts the balance that has favored foreign investment back to U.S. investment. But there's a lot of hard things going on in the economy, a lot of things that are unrelated to what happens in the tax world. And I'm not familiar with the situation you described, so I can't comment any further on that. But I do think it'll be positive for jobs in the U.S.
I think if we look really closely at a bunch of different firms, we'll see that the cost of investing abroad has actually gone up relative to 2017. So I'm not so sure that this is going to be driving firms abroad.
Yes. And after you, we might have one more. So,
Hi, Ryan Bandari. I'm an economic policy advisor. Just with, it was mentioned before that we used to have a hybrid in one sense, and now we have a new hybrid, and the incredible amount of complexities that are now associated with this new, base erosion, anti-base erosion tax system. What would be the problem with just coming at it from a more simple aspect of having a worldwide tax system with no deferral and calling it a day there?
Well, I'll let you go. I was going to say we could lose all our companies. That's just one knee-jerk reaction, which is it's going to. So current taxation with no deferral at a 21% rate. Yeah. At the 21% rate. Well, it's probably better than the current system, but I think it's not as competitive as we might like.
So if your question is motivated by simplicity, it's not clear that you really gain that much simplicity. You gain some, but you still have to have a foreign tax credit system, and you still have to have a certain amount of rules. And then I agree with Roseanne. It's it makes it, if you're a business that's predicated on having a worldwide operation, it does raise your effective rate for being a U.S. resident corporation. And so I'm sure that some companies, I don't know if all of them.
No,
but
I wanted Rich Rubin to quote me.
Last question. Yes, you had your hand up.
Thank you, Leonard Campbell. If you could just speak to the incentive for not necessarily an established company, because I understand that it's difficult to shift everything around, but nascent companies to headquarter in the United States, given that the rate that we're talking about is pretty much middle of the road, and the rules as written are fairly complex. There are places where you could go where the rates are obviously lower, and the laws that you have to comply with are much simpler. So what is the incentive to look at this as a great gift horse?
I guess the question is, what is the incentive to headquarter in the United States, given that our rates are in the middle?
I think I actually don't know what the answer is, but I got to say, one concern I do have is that in a regime like ours with a minimum tax and a minimum tax that applies a lot to intangible income, and if you have the next Facebook, do you want it to be a U.S. company? And it's not clear because you pay full freight in the U.S. and then you pay 10% around the globe. If there was a way to get out of that system, that might be. If you could be somewhere else, that might be more attractive. And again, I think that's going to be determined in part by the worldwide changes that Pam discussed. That if those kind of loopholes or the gaps between real tax systems continue to close, then maybe there won't be that many opportunities for that in the future. But it does make me nervous.
But we do have to think about how things were before this law, and I think that you have more of a reason to be here than you did before this law was put in place.
The 21% rate.
21% rate,
Yeah.
And no repatriation tax. Right.
If your argument is like, if I can get zero somewhere else, then is 21 better than 35? I don't.
Well, of course, there's a slew of non-tax reasons that we're not getting into as to why you might want to be in the United States, headquartered. Yeah.
I'm afraid we're going to have to call it a day. So thank you all very much, and